Hi, everybody. As folks filter in, we'll do some quick kind of high-level intro of the event series, and then we'll move into our scheduled programming shortly. For those of you that have never joined us before, this is the Enduring Planet and Friends community event series. We meet monthly, with the exceptions of actually, I think we do it monthly even during the Climate Week months. We've been doing this for, oh God, a year and a half now. Covered lots and lots of topics, always at the intersection of climate tech and finance. The goal of these events is to be highly tactical, very candid, and current. And so um, that's what you'll get today. I would ask all attendees to make sure their video is off unless they're a speaker. The chat is open. We love discussion in the chat, so please feel free to drop any questions or comments as they come up. If you don't know an acronym or a finance term, don't be shy. If you have any question is a good question. I'll also ask the speakers to monitor the chat to make sure that we can kind of respond in real time. For things that warrant kind of live dialogue, we'll add it to the agenda, and otherwise we'll try to be responsive in the chat itself. Um, Hannah, anything I'm missing on the kind of broader overview? No? Okay, great. Well then, we're gonna get into speaker intros. Since I already am speaking, I'll introduce myself. I'm the moderator today. My name is Dimitry. I'm the co-founder and CEO of Enduring Planet. We do two primary things in climate. We are a provider of working capital or debt to climate startups and small businesses. We've done over 100 transactions in the space and lend across stages. As long as you have a contract that's creditworthy, we're happy to chat. And then we also provide fractional financial services to climate companies and SMBs and nonprofits and funds. We basically handle the finance back office, and we have about 80 clients in the space today. So I'll pause there. Let's go down the list. Maybe Hannah, then Supratim, then Noah, then Laurie, in that order. And just let's do quick, 90-second intros, please.
Wonderful. Hello, folks. I am a proud partner of Enduring Planets. I work at a company called Lupine Finance. We are the strategic CFO layer, helping companies make decisions as they scale up in emerging industrial infrastructure. I have a background in early stage venture capital where I helped launch funds from scratch, which gives me an investor's genetics that I bring to helping founders from the operator side of the table today. Truthfully, this session was born out of curiosity. I think I spend so much of my time pulse checking, even on a monthly basis, where the goalposts have moved at the Series A and B stages as the market has moved around. So I felt idly curious. Sorry, not idly curious. My clients have been asking me specifically these questions that we're going to tackle today. So I pulled together both friends and some of the smartest people I could find to help us answer them. And with that, I'd love for Noah to introduce himself.
Yeah, happy to. Thanks for having me. Hi, everyone. My name's Noah Geeves. Zoom has me down just as Noah, but I'm really not famous to go just by one name. Yeah, head of portfolio and partnerships in the climate team at Deep Science Ventures. We are a venture studio. We create companies from scratch. We've created 60 companies to date across four different sectors, and climate and energy is probably our biggest sector, which I'm in. Everything from direct air capture to green hydrogen to decarbonizing the cold chain, really super broad. My role is really twofold, but the one that's relevant to this is around how do we get our portfolio to scale as quickly and effectively as possible. And so really looking across the entire journey, really from pre-seed up, and seeing firsthand how the expectations change at investor level. Other than that, I'm a chemical engineer by background and spent 10 years as a founder. So I've also seen some of that as well. Over to you, Supratim.
Thank you, Noah. Hi, everyone. I'm Supra, like the car. It's easier to pronounce than the full name. I'm Vice President of Finance at Electrified Thermal. We are an industrial heat company. We make these bricks installations you see behind my head in the background. converts electrons to really, really high superheated air that can be a one-for-one replacement for natural gas. And we're the only solution that integrates into high voltage and can scale to gigawatt scale heat at 1800 Celsius. By way of background, my formal degrees are in chemical engineering, applied physics, and finance. I spent a lot of time in early to mid-stage climate tech venture capital, and then spent the last 4 years in a green hydrogen company on both the corporate development and commercial finance side. And at Electrified Thermal, I own all of finance and capital markets. Laurie.
Thanks, Supra. Hi, everyone. I'm Laurie. I'm a founding partner with At1 Ventures. My background, I'm a biotech engineer by training, and spent my career focused on deep tech commercialization. I worked several years in the chemical industry. That was during the clean tech 1.0 and learned the hard way about kind of key mistakes we made back then. That was with Solvay and with BASF. And I also worked with the US Department of Defense, co-founding a dozen of deep tech companies, basically taking military technologies, mostly hardware, satellites, robotics, and bringing that to the market, and also learned the hard way about scaling hardware products. And back in 2020, ended up co-founding At1 Ventures with Tom Shi, who came from Google X. We've raised 3 funds so far, over $700 million. We do hardware, investments, climate. Our thesis is really around this triad of deep tech leading to superior unit economics and environmental economics. And we have now 50 portfolio companies. And yeah, we do mostly Series A, seed stage investments. So really excited to talk about metrics for deep tech investment today.
Welcome, everybody. What a group. I'm really excited to dive into this conversation. So I think for folks joining, the biggest questions come from the fact that a lot of venture capital frameworks are built around software. And a lot of the kind of dogma that you hear in the market, the repeated, oh, 1 million or now maybe 3 million in ARR, the kind of growth multiples, 5, 6, 6, 2, or whatever people say, right? Like those things are really hard to apply to deep and hard tech. And I think we assembled this group to get at that specific answer. And so to kick things off, and maybe this is for folks who wanted to join for like 15 minutes, I want to just get this question out of the way. For everybody in the room, what have you seen in the market today for like actual milestones that unlock a Series A in deep tech, right? And I just want to do like a quick, call it rapid fire round robin. What is an actual milestone that you're seeing unlock a Series A? Is it a technical proof point? A large customer contract, a cost curve reduction, a big team hire? What are you seeing as that milestone? And maybe Laurie, we can start with you.
Well, many things. I think there are some fundamental kind of milestones I'm looking for. So technology kind of de-risking is one thing. Moving from what I would call mid lab bench to late lab bench, where you have results, you can demonstrate that the technology works. You can demonstrate more specifically the unit economics. That's something I'm very focused on, really from the physics fundamental of your solutions. Can you beat the incumbent technologies? Because if you're building a green premium, for me, it's like no go. So being able to demonstrate that from lab experiments is core for me. And then demonstrating that there is demand from the market. And demand from the market is not, oh, that's a nice to have. I have a few LOIs or have been able to do a couple of pilots with customers. I want to talk to those customers and I want to see that people are very excited that your solution is a must-have. And as long as you're able to scale and produce, there will be demand for your product. So for me, that's really the two main topics at the Series A.
Supratim, would love to hear your comments on this too.
Yeah, I agree with Laurie, and I think what I've been seeing is what the market was looking for in a Series C in 2021 is what they're looking for in a Series A in 2026. I only half joke. Um, I think generally, as we've been out in the market, it's been everything in the kitchen sink of like, hey, do you have a fully scaled up and de-risked technology, and do you have paying customers with contracts that are binding, and do you have third-party validation on your technology? The pathway from Series A to B is like, oh, do you have multiple contracts? And is Series B the last round that you will ever do? Because we don't want to get stuck in the alphabet soup of venture capital where everybody gets diluted and you never actually build a business that's money making. So somehow I think there's been a contraction in the letters because people want returns faster, driven by general investing landscape in AI and tech. And what I have seen is there's a lot of flight to quality for Series A,
Mhm.
especially around both on the technical side is what you are making work, and also is there someone willing to buy what you are making? Um, and then it varies between counterparties on at what scale they look for. Some people want fully contracted customers on the industrial scale. Some people are all right with the pilot initial customer, but there should be a solid answer to those two fundamental questions.
Hannah, what are your clients seeing in the market?
I'll give you an answer and an addendum. The answer, in my opinion, the minimum one you have to have a multi-million signed customer purchase agreement of some kind. It has to be beyond pilot, and to Super and Laurie's points, somebody's got to pay for it. I say that's the minimum in the market because I am seeing Series A's get done where there still is outstanding technical risk, and I am seeing strategic step in and validate that that technical risk is tractable even if it's not accomplished. And so I say that as like that is what I'm seeing as the minimum. My addendum is that you always, at the Series A, have to have an answer to the question, how big and what type of capital is going to be the next round of funding? And I think that this has become increasingly important in this market because investors are so aware of what has been the dearth of the Series B funding and how blended that is required. And if you don't even have an inkling of that idea or you haven't modeled what it could be on order of magnitude, gone are the days where investors will take billion-dollar capital intensity or capital outlay risk. And so at the Series A, you have to be able to answer that question with 50% confidence.
Noah, you want to throw one more thing in here, and then I want to come back to Laurie, given what Hannah just said.
Yeah, I mean it's hard to add much more than that. I think it's pretty comprehensively covered. I think I'd add maybe a couple of bits. One is I view it much more as a floor. Like it's pretty binary. Like you have to hit certain things, and above that, then that's your, I guess, the milestone that unlocks it. And in that case, it is very much commercial. And so um um the high confidence on offtake, high confidence on contracted revenue is definitely the thing. I think I one data point that I've seen, which probably goes slightly lower than Hannah's bar, is an unsigned offtake term sheet. But the flip side to that was that they were able to call up that blue chip commercial customer and go, "Are you in?" And it was like, "Yeah, we're in." So like functionally, it was signed. The only thing I'd add is emphasis on cost down curve, particularly if you're selling into a commodity market. Which I mean, a lot of people are, right? It's very much on how much faith can people have in your ability to come down the cost curve.
Right. There's a lot of stuff that got covered here that we're actually going to come back to throughout the session. But Laurie, I want to come back to you because in the past you've talked a lot about how like realized revenue is not the right thing to focus on at this stage. That a company growing like from I don't know, a few $1 million in revenue with some consistent year-over-year growth is doesn't necessarily tell you whether or not they can scale to 100 million or a billion, right? And so walk us through how you sort of underwrite this path to scale if the early realized revenue traction isn't actually there. And I think to sort of Hannah's and Noah's points, like, yes, you could have this large contract offtake for future revenue, which is helpful, but I'd love to hear what else you look at.
Yeah, and actually, we got the case with the portfolio company at a board meeting where we were kind of defining the milestone for the Series A in terms of how much realized revenue do we need to get? Is it $2 million? Is it five or is it 10? Tell us. And I was like, people won't care. The Series A investors won't care about if it's two, five, or 10, because if it's 10 and there is no growth behind that, because you've only locked one customer and you cannot grow within this customer, or maybe this 10 is within a super niche market, it's not going to get the Series A or Series B investors excited. What gets us excited is to see the ramp in terms of revenue. So maybe today you have nothing. I see a bunch of Series B with no realized revenue, but you have a very large offtake agreement behind that. Can be an offtake agreement with dozens of millions of dollars, can be $100 million, can be even in the billions of dollars size. And this is what gets me excited because as a VC, I'm looking at 100x, 1000x on multiple of valuation at the entry point of my investment. And to get to those multiples, it means it's not the 1 or 2 million type of revenue I'm looking for. It's like a huge number. And so to me, what matters most is can you demonstrate this growth because you have customer excited about it? And once you sell to a customer, we know it's going to grow from a few $1 million to hundreds of millions of dollars of revenue. And again, back to what I was saying earlier, can you demonstrate that the technology works and is performant, at least on par with what's already on the market, and also at cost parity or cheaper than what's on the market? So that's how
Yeah.
I look at it. And sorry,
I
that
want to,
looks scary, but the 100x, 1000x is what we all look at as
yeah.
a capitalist.
Noah, coming back to you for a sec. We talked a little bit about this sort of technology de-risking requirements for Series A, and I think you have a framework out there that talks about kind of TRL 5, 6, and a pilot online with performance data as being a prerequisite for Series A. Is that still the case? Are you seeing a lot of variance across deals where folks can get it done earlier, or is the bar even moving higher as the market evolves?
Yeah, I would say that TRL 5 or 6 is for something that is lends itself more to be a stick-built project in the future. If you're doing something that's way more modular, I think actually the expectation might be higher. I mean, an example would be we have a company that is doing that is focused on decarbonizing the cold chain, and it's a bit more modular in nature. By the end of the seed, they should be at something that could be productized, and actually, that might be product one done, at least the first iteration of it. And so, I would expect them to be higher. So, yeah, I don't know if that fully answers your question, but I think that very much is the bar, and that's for something that's stick built.
Maybe like piggybacking on this, Supra, coming back to you. What were the kind of key milestones that made ETS's Series A story credible to your investors? And what was it? What you expected going into the raise versus kind of what came out of it? I'm curious about that.
Yeah, I think that's a good question, and I appreciate Noah and Laurie's perspectives here. And I also see some chatter in the chat around revenues and offtakes. And I think the perspective that I've had in the market from an operator standpoint is, the discussion around revenues is nuanced, both in the US and EU. And that's an important one. Among the top three questions that somebody asks you is like, okay, what's your commercial story? And there's three main pillars here that I think could help the folks in the audience who are thinking about raising. One is if you have revenues in the bank, or if you are going to get a binding contract, if you're selling a widget or you're selling a product that comes out of the thing in a own and op, build and operate type of model. Either way, if you have cash in bank, that's great. The more important point I think is where is the next cash going to come from? And that's where one, offtake structures do get scrutinized quite extensively, both across geographies. I've been in the capital markets in US, EU, as well as in the Asia Pacific. And I can say that that's a pretty contiguous theme around, okay, where's your next revenue going to come from? And I know that we're going to talk about ARRs today, but the concept of ARRs is not really a thing for hardware that takes time to build. And so you have to look at it on a one-for-one basis. And the third thing is velocity of revenue. This is a new learning that I've had, I think, in the market that I previously wasn't thinking of or was top of mind is a lot of offtake, especially in climate hardware. When you build the first thing, does that unlock a windfall of future projects? Because things take time to build and learning cycles are slow and sales cycles are even slower depending on what industry you are in, and especially if you're in energy hardware, that is true. And so people want to know that if they back you and they wait X number of months or years to have you prove out the first unit, is that going to lead to another 3 years of pain to build out the second unit? Or is that going to lead to 2 more years of flourishing where you put out 5 more units from the learnings you had because you have proven out the unit economics and you have proven out the way to the world that you can do this. And that velocity of revenue component is something that I'm seeing investors underwrite to a lot. In addition to the first two things that I said around the quality of revenue and the quality of offtake. Those were the biggest things I think that we have been experiencing on the revenue side. And the last part that I'll end with for this question, Dimitri, is on the technology side, it's awesome to hear Noah and Laurie present a very thoughtful approach that, hey, we want to look at where you're at, maybe start at TL 6 or 7, but even higher. I have found that, there is very little risk tolerance for any kind of technology risk at this time because the alternative for a lot of investors is no technology risk and no market risk in another sector. And I have found very few folks who are willing to take an and. They might take an or approach where there is a strong commercial backing and future offtakes binding contracts, but there is a little bit of tech risk to be retired. I've seen investors take bets on that. The other side, I've also seen where there's fully de-risked technology, but a little bit nebulous on the commercial side. But I have not seen an and situation versus an or.
Can
And if I
I
can
ask
maybe comment, oh yeah, go ahead.
you go, Laurie. I'll ask a follow-up. It was just on the
I'll
come on.
just comment on what Supra just mentioned. Yes, on our side, for example, we don't take science risk. So at Series A, we are expecting that you've de-risked the science in the lab, but we take technical engineering risk, which is different. And there are many investors like us, especially with technical background, who understand that once the science risk is out of the table, the technical risk is actually less so if you have the right people that understand how to scale and understand engineering. So that's it. No.
That was my exact question. No, you answered it. That was going to be my exact question.
And I want to add here there's this conversation in the chat happening about offtakes and what to do specifically to apply that to industries that don't typically have offtakes. And I think Super's point about this or function and Laurie's point about what is engineering risk there can also apply in instances where maybe you ultimately become the OEM or licensor of a piece of equipment and you will not go project financing, and therefore you do not have offtake agreements and feedstock agreements and EPC wrappers in the same true project financing sense. This conversation has used offtakes a little bit synonymously, but consider that to stand in for some type of real customer purchase agreement. Could be a purchase order. It could be a purchase order before you're ready to manufacture those units, but it needs to be something toothy, like with real legal teeth, where the customer is demonstrating that they want to stand up and say with their money that this would be of value to them. Kind of nothing beats that. And it can apply across industries. So even if you're in a commodity industry like cement is a really good example, long-term offtake agreements just don't work in that market. They just historically never have. And so you need to figure out how to spoon feed the investor audience why in your particular market for your particular business model, this customer agreement actually fits that model of demonstrating upfront kind of engagement.
And we talked about this a bit too in our session that we did with the CEO of LanzaTech. And so for folks, Hannah, that was our folk one, right? I think so. Yeah. So for folks who are curious about like how do you navigate this like offtake valley of death slash weird industries, you should take a look at that piece. It's in our Insights series, and maybe Hannah, if you can just drop a link, I don't know if you have it handy. So I want to I want to dig into this a little bit more because I think there's a lot of difference between kind of commercial pilots that are paying letters of intent, uh, offtake agreements, take or pay. Like there's a lot of variability into what these things actually mean. And so maybe Laurie, for the people, there's also some comments in the chat about like the absurdity of VCs wanting a commercial long-term offtake agreement at the Series A. Like it feels crazy to me if you're doing early stage deep tech. And so for 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 entrepreneurs who feel like they're kind of in this valley where they're like they can't win, right? They like need more resources to go from pilot to offtake, but people aren't willing to invest. Like, how do you think about that? And how do you what advice do you give founders about sort of converting that early pilot work into something that feels commercially viable for a Series A investor?
Commercially viable, and I think it's again demonstrating that there is demand and somewhat you can lock that demand. And then the only bottleneck is being able to scale production. And you know that if you scale, revenue will just flow in the company. So ultimately, the name of the contract, I don't care. I don't like LOIs in general because LOIs are super high level. It's, oh, we love what the company is doing. Maybe we'll buy stuff in the future. If you have an LOI that is super specific, where the company is like, we like this technology for those reasons, we are looking for those specifications with a list of specifications. And if the company meets the specification by this specific year, we'll be able to buy this volume. I like that, even though it's only an LOI. So I think if you've not been able to sign a binding contract with a customer, but you can get this specificity from customers that demonstrate that there is real demand, those type of contracts will get me excited, especially if then I can talk to the customer and I get confirmation of the excitement and the fact that it's a must-have. Because yes, offtake agreements are hard to get. Sometimes it takes time. What I've been doing with some companies, we had companies where basically the customers were like, okay, you have the best technology, the performances are better than what we have, it's lower cost. So come back to us when you have the capacity and we'll sign the offtake agreement. If you have investors that trust you, what we did was just a bridge internally to just get started on the first manufacturing line to demonstrate that the production will come pretty soon. And this immediately unlocked offtake agreement. And I can tell you in this case, we unlocked a $1 billion offtake agreement. That was our first offtake and it was huge. So sometimes it's also making sure you are surrounded by investors who understand what it takes and in the investors who trust you and believe in the business.
Hannah, I want to come to you and change gears just a little bit before we start moving towards talking about Series B. You know, we talked a lot about milestones and metrics and performance, but I'm curious if you're seeing requirements in the market around sort of financial infrastructure. Like how prepared do entrepreneurs need to be to take on this financing? What do they need to have in place? Like what does a strong sort of financial operator look like in terms of what VCs demand in the market?
Great question. I think that there's kind of good, better, best in these scenarios, but like you at least have to be really good to get Series A done. The bar in this market has just dramatically risen for folks. I think good really looks like you have to have a robust, auditable, like very clean financial model. And that financial model needs to clearly articulate the core assumptions and the sensitivity to those assumptions. It needs to be TEA integrated, it needs to be pipeline integrated. It doesn't necessarily have to be a three-statement integrated financial model, but you got to have a P&L and a cash flow, and it has to demonstrate that pathway over time in a way that ties a pretty little financial bow over the entire story of your business. And if you don't have that, it's not good enough for the Series A, in my humble opinion. I think better and best really look like, I mean, baseline, you're always going to get asked for audited financials at the point of the Series A. The last thing that you want for any closing round is like for your books to be a mess, and for that to trip you up in legal diligence post term sheet. Like, don't let it happen. You should be hiring Enduring Planet if you're even remotely concerned about that. That is my shameless plug for Dimitry. That's like what bad looks like, is when like you get tripped up there. On the better and best side, I would say like you're kind of seeing it on this call. Like people hire folks like Supra who have deep backgrounds in both product communication, technology communication. You can put Supra in front of an investor and he can talk shop about deployment and the product's level of science versus engineering risk. And he can also translate that into what does that mean for the unit economics at scale? What does that mean for the costs of the financial model at scale? And he understands the dynamics of the investor. Having that person in the seat to own the Series A is what best in class looks like. It can be a VP of finance, it can be a head of commercial, it can be a CFO. It doesn't really matter how you title that, but like someone's got to own that with investors' genetics and with a clear articulation of the market. And
Uh-oh.
no, I'll stop there.
There we go. Oh, you cut out just for a second, but that was great. Thanks, Hannah. Okay, I'm going to ask another rapid fire question before we move to Series B. And seriously, like maybe a sentence. What is a metric that you've seen founders over rotate on for the Series A, where they like invest a lot of time, and then it turns out it doesn't matter at all to the people they're talking to? What's one? Let's do Noah, Laurie, Supra, Hannah.
Do you want to skip forward one and come back to me?
Okay, Laurie.
I was focusing on something in the panel in the chat and got distracted.
Oh, good.
I'm the same. I think maybe LOIs. We talked about LOIs. I have, yeah, sometimes founders who pitch and are like, oh, I got 10 LOIs, but stuff are super high level. It doesn't matter. So I think, yeah, this one is overrated.
Okay, Supra.
The question was, what is one thing that people care about, one thing that people don't care about?
No. What's one thing that founders think that VCs care about that they don't actually give a shit about?
Hmm. I
I
think,
can jump in. Oh, sorry,
yeah,
Super.
one thing that I've found is, a lot of, I think this is a nuanced point, and this has been a learning for me as well, is, I'm in the world of industrial heat, and we're not the only people who make bricks to convert electrons to heat. And everybody is out there trying to beat their chest about why their product is better than their competitors. When I put myself in the VC's shoes, as someone who's done that role for a couple of years, um, I don't think the investors care about why your product is better than the other person. Like, I think that the nuances around technological differentiation is manifested in commercial traction. If there is a specific product feature or differentiation that you think separates you apart from other competitors, the proof should be in somebody else recognizing that, who is willing to pay for the feature that you have. And it's not the investor's job or the onus on them to figure out, oh wow, like where should I take my bet among these 10 companies in the same space that has pitched to me? And I think that I've seen that increasingly become real in conversations, is I don't think VCs care that much about technical differentiation as long as you are selling a box where the economics works and you can make the money. Because honestly, they're inundated with everybody talking crap about the other person and putting themselves up. And it's really hard for a venture capitalist to wade through that and say, oh, you know what, this is my bet. I'm curious what Noah and Laurie think, but that's kind
Yeah.
of my
No,
experience.
and
Spicy.
Supra, yeah, I hate that. Please don't talk badly about competitors. Actually, I had someone pitching to me earlier today, and I really like this guy because he was talking very highly of the competitors. So he tells me he knows them, he understands the market well, and then he was just talking about how different they were and what type of different value proposition and needs, different needs they were accessing to the customers. But yeah, don't talk badly about competitors, it doesn't show well.
Yeah, I mean, I think there's a show don't tell element to this, right? If you're truly differentiated, your customers will know it, and that'll be reflected in the pipeline you have. The a point that I would add is, fundamentally, the whole thing we're going to talk about today is really just a schedule of risks, right? And that the schedule of risks evolves over time through your Series A, through your Series B, and onwards, and starts. You should have visibility, ideally, on your Series B schedule of risk at pre-seed. You might not touch them, but you should know where you're going. And so anything that sort of deviates off that schedule of risk that really takes you to the finish line is probably not something to spend time on. So booking generic revenue for the sake of it, right? Like, oh, I've got some revenue, but it's totally irrelevant to where you're going, right?
Mm.
Waste of time. And so I see people spend a lot of time on things like that, and it's just unnecessary.
I
Awesome.
I will make mine quick here. It also answers one of the questions in the chat. I was talking about this morning with a, commercial producer of PFAS production technologies, and they were saying, look, we have these huge policy inflection points. When does that unlock debt and working capital in our capital stack? And I said, you should never rely on the private markets to care about a policy inflection point. And I think, unfortunately, we over rotate to that, and it needs to be gravy for the business model. And you have to have a baseline plan and strategy for survival without that. Um, Unfortunately. And if it is gravy, then awesome. And I think that maybe is most true of the US market relative to my European counterparts here for now. But I will say most investors want to discount that completely. Dimitri, before we move on to Series B, can we touch on the external validation of how do you prove the difference between science and engineering risk, and how do you engage EPCs at the Series A stage? So maybe I'll jump into moderate and bring that question straight to
Do it.
Supra and then
Do
and
it.
then open to the room. Supra, what's your take on like the role of EPCs, the role of external validation for engineering risk at the Series A specifically?
Yeah, I think it's on the lower side of the Series A. It gets a little bit more important in subsequent rounds. I have firsthand experience with this through my 4 years in green hydrogen, building green hydrogen projects, and now in industrial heat. Um, we've done work on the ground both in the US and EU, and some in the Middle East. And I think that it's a big ask. In the Series A, teams are small, capital is light, and getting things on the ground with contractors is hard. And so the thing you see behind my head, this was built when the company was 15 people in total on the payroll, and this is the largest and highest temperature ever commercial scale unit on industrial heat. And but it becomes hard to replicate at a Series A stage when you don't have the subsequent capital to build another one and another one. And so I don't think a lot of Series A investors or anybody would put a lot of emphasis on having robust EPC contracts and really knowing your way around contractors and having that deployment muscle is what I call it. I think that becomes a little bit more important in Series B and beyond, and maybe even late Series B, depending on the size of the raise and how you term those letters in your progression of the business. Um, it's important to have, and it's absolutely critical keep overall costs down. And we talk about unit economics all the time. I think a lot of people in Series A stage don't realize how much costs can balloon in your unit economics model if you don't have the deployment muscle figured out. But I don't see that as gating in terms of investors specifically getting comfortable in a Series A raise, although they will ask. And if there are sophisticated investors who really get it and who've been in the deployment contracting world, they will also help you figure that out. So I see that more of a partnership than a gate on Series A and becoming more important for Series B and beyond.
If I can just comment here, I agree. It's not a gate, but it's unfortunate because I think the VC industry today, early stage and late stage, is still lacking this discipline around capital-intensive businesses and how you scale that. I've learned the hard way about it, and if you look at deep tech in general, there is a graveyard of companies that have been highly capitalized and that ended up bankrupt or in distress situation. You have the public one like Northvolt, which ended up raising $16 billion. You have Proterra, you have Solindra, and so many others that are not public yet. So we need to get that much sooner in companies. Now, with all of the portfolio companies I work with, even at the seed stage, I'm bringing manufacturing people on board. We have 3 manufacturing VP manufacturing with At1 Ventures that are working with the portfolio companies because this is so key. And so I think Series A, starting to engage with EPC firm, with contract manufacturers, with manufacturing people is essential because as Supra mentioned, the cost just balloon. And usually as a founder of a seed stage company, many people come from academics, from the lab, have never scaled a business before, have never built a manufacturing line. So this is really key. But indeed, it's not a gating factor because most investors don't have any clue about scaling hardware businesses.
Yeah, I think the only thing I'd add is, I've spoken with EPCs themselves, and actually they like to engage early, right? The last thing they want is you've gone and maybe built a pilot plant, maybe slightly bigger, and you come to them and go, "Hey, here's what I've done. Now can you just build a bigger version?" They're like, "Well, actually, we would have done all these things different, and if you'd engaged with us, it would have been significantly cheaper than us basically having to redesign all your mistakes." I think on the point about external validation, I think this is probably where you can talk. Like this is probably most relevant for where there's an overlap on the science risk and maybe where you've got some like electrochemistry is probably a good example of this. Having externally validated performance, like I wouldn't say guarantees, but something similar to that from the people you're working with on your electrolyzers, for example, is a great thing to have, and you can do that. You don't need to wait till Series B to do that when actually you might engage with an APC and fee. But yeah, that's what I'd ask.
Man, in summary of that conversation between the three of you, that was amazing. You as the CEO have to identify what talents you have internally in your partnerships or that you need externally. And you have to identify the bias of the potential investors that you're working with in order not to miss those things. I think it's very tempting for early stage companies to think, I don't need an EPC. They move too slow. They're too expensive. I don't need to worry about manufacturing yet. I just have to get this first thing built. And sometimes that can be true, but you have to know that those are the trade-offs that you're making. And Noah and I got to collaborate with a firm called Mark One. Mark One does project development services for companies. We worked with a company called Via Separations, which went ahead and built during the summer of Alberta, Canada, their own first of a kind project at a paying customer site. And they intentionally did not go with an EPC. And this is all public information, and we published a report on it. They ballooned their labor costs by over 50%. I'm sorry, 2x the budget in that process. And every EPC was like, you would never have done that with us. But their answer was, we never could have afforded you and preserved our runway, and we would never have gotten it done in that very short summer. But there was an intentional understanding of what those trade-offs were. And now the company is kind of working into more of a system to then repeat that over scale. And maybe that's a good way to hand it back to Dimitry. Guide us into the Series B stage, because I feel like the summary of Series B is show me the repeatability, show me the muscle that like proves you're strong enough to do it again and again and again.
Yeah, and we also talked about this in the folk event and the commercial. There was like a follow-on event we did about financing commercial projects. Uh, there's also, I think, this trade-off of like we want to learn the full stack process to really understand it versus offload some of it to another party, and those are choices that companies need to make. Okay, so transitioning to Series B, I think we're kind of on time, maybe a little behind. So I want to do just a I'm going to actually ask everybody this question, and we can maybe spend on this a little more time on this than I planned. But obviously, as we're seeing in the market, Series B is like a lot harder than Series A, and often it's because investors want to see this path to scale, despite the fact that maybe the actual scaling is like not very linear. You can't just like hire more salespeople or buy more ads to just crank out more SaaS subscriptions. So for folks out there in the market who don't have kind of like a common growth curve, how can they tell that credible story? And is this just more about, oh, expanding offtakes, expanding, contractual commitments, or is there something else that folks are doing in the market that communicates that path towards, really, really large outcomes? So maybe I don't know, let's go backwards. So Hannah, Supra, Laurie, Noah.
I'm passing the baton to Sue.
Do it.
I think Series B, the game becomes a little bit more around the second pillar of a revenue that I mentioned before is velocity of revenue. How quickly does your company have the ability to get revenue and sell product, no matter what the business model is? You could be owning a build, own, operate. You could be selling as an OEM. You could be licensing. But how quickly can you get revenue in the door? And what is the mechanism to do so? And is that a credible, logical pathway to do so? While building the first unit has its own challenges, building the units 2 to 5 is a separate set of challenges, and building units 5 to 10 is also a completely different set of challenges, both from an execution standpoint, but also from a financing standpoint. Um, the On the execution side, let me touch on the financing side first. On the financing side, you can't hope to keep raising venture capital money and using that. And again, forgive me if I keep talking about energy hardware. That's my entire life. So um, that's sort of been my jargon. But if you can't use venture capital money to buy pipes and pumps and heat exchangers and coolers, that is an objectively bad use of that money. So the immediate next question becomes, okay, then what do you do? How do you put that money to work? You put that money to work in assets that are growing the business, hiring people who are going to grow the business. And then you have to get lower cost of capital cash to layer on to the venture money that sits on the balance sheet. Now, this is where the entire game starts, because lower cost of capital cash is also more risk-averse cash. And when it comes to, and people love to talk about project finance, working capital facilities, there is very, very few project finance facilities being underwritten in energy hardware today. There's even fewer working capital facilities of any meaningful size being underwritten. And because the reason for that is the realization that goes from happening Series A to Series B is, okay, I need to be able to do what I built. So this thing on the back, this is a stick-built unit, which means this looks cool and it's a nice thing to look at, but can I repeat that over and over again? No. I have to figure out a way to standardize the design such that it can be shipped repeatedly to customers, for example. And so when lower cost of capital financiers come in, then they're going to ask about, okay, how are you building this stuff? How are you going to ship this stuff to whoever you need to sell it to? What is your operating data on the things that you have already built? And how do I really know that this is going to be meaningful? And that's where businesses run into a lot of problems, because that Series A to B, and why Dimitry mentioned this to be quote unquote much harder is because these realizations tell you that, oh, I have to spend a lot of time, effort, and money, and maybe another private equity round to make my business ready to receive lower cost of capital cash. And that tends to be the biggest surprise for a lot of companies transitioning from A to B. And also a big pitfall for investors as well, because uh, the early stage investors end up getting diluted by startups just resorting to building these things on balance sheet. So that's kind of been, I think, the biggest roadblock that I have seen going from A to B, and the biggest realization that entrepreneurs and founders need to keep in mind.
Thanks, Supra. Hannah, anything you want to add? Go to you? No? Noah, Laurie? Any comments on this one?
I mean, super comprehensive answer by Supra. I think the only thing I'd maybe add is I guess the extra focus on suppliers and manufacturing that comes in with this, particularly around, if you've in prior stages been working with a supplier who can only do 25% of your pipeline, well then, that's not going to be a long-term solution. And so I think that's where, this focus on multiple sites and all of the things that go around the supporting infrastructure that goes around delivering that really gets put under the microscope, so to speak.
Actually, this is like a perfect point. I want to transition a little bit, and Laurie, I'll come back to you, but Supra said something about sort of the fact that kind of as you move from project Series A to Series B, it becomes almost a different business. You're like you become a project developer, right? In a lot of ways, for a lot of deep tech, high investment companies. Less so for, I would say, maybe smaller hardware, but even in the cases of, folks developing novel heat pumps, they're doing large projects where they're deploying, 10,000 units with like a New York Housing Authority. There's a lot of similarities. And so I guess I'm curious, Noah, as you see teams kind of move from this like technology de-risking to commercial de-risking and project development, how does that transition actually show up in people's metrics? And how do you know that a team isn't like really ready yet for that transition? Like how do you identify that when you look at a company?
Yeah, I mean, great question. I think
and maybe Laurie, you can also chime in on this too.
Yeah, I mean, I think it's great question. Huge answer, I guess. I mean, there's a whole load of things that's underneath there that Supra is largely covered in from a risk register perspective, right? This is around, I guess, the supply chain capacity, operational replicability in particular. But I think actually how does the team change? I spoke to a whole load of founders at Series A in the week preceding this, just trying to pick their brains, see how the market's changed, and actually what have been the biggest things that they've changed. Actually, what's funny is a lot of it came to the team. And so when I was speaking to one of them, one of the biggest things that's been a huge, like beyond the expected things, right? Beyond the expected things of going from different technology developers to project developers and all the skill sets that sit there, was a procurement professional. Having a procurement professional in the house who can play suppliers off about one another, move some of, you might think that you have to do all the R&D. Well, actually, you can actually push some of that to your suppliers and the expectations onto them, and just put that cost base with them for the long-term benefit. They're seeing long-term benefit by supplying you and you paying them, right? And so actually, that was this really surprising one for me, which I'd underappreciated before.
Laurie, anything you want to add on this sort of transition from technology developer to project developer?
And again, it's back to this engineering risk, and it's the people you have in-house. So I'm looking like at manufacturing people, supply chain people within the team, back to Supra's point around capital. If at Series B I see the company wanting to raise only equity, there is an issue. Especially if you want to buy capex, don't use equity to buy capex. Look at equipment financing, leasing, venture debt, all of the things. So that's also kind of tells me the maturity of the team in terms of going to the next phase. And then it's back to the background of Supra here. This is hard to make, and then it's hard to replicate. So do you have the right plan in mind in terms of first intermediate scale up and being clear on your yield or on your unit economics, and then you take that for one unit and you multiply. So those type of conversation, you can tell very quickly if the teams are ready or not for the Series B round when you ask those type of questions.
Awesome. Hannah, I want to come to you, and I'm curious, what are some of the metrics that you see Series B investors constantly ask for that founders actually don't track very well and or maybe can't respond to immediately? Like what are the questions that come up where folks struggle to respond on a timeline that actually gives people comfort? Because I think that's also one of the things that we see in fundraising is that the more quickly you can respond with a clean answer, the more trust you build, right?
That is a good point. It demonstrates a level of you've thought about the risks of your own business and you're ready to have some scenario plans to tackle them. At the Series B stage, I think some of the things that are most lacking, well, it really ties to the conversation we were just having, but I think when I see executives and their board members who are operating in a bit of an echo chamber and they're not building a almost diverse team of rivals with these procurement, manufacturing, and engineering, delivery, customer success, finance integrations, when they're not building that cross functionality and they don't have answers to what that team or VP suite or C suite needs to look like at scale. I do find that that's a big gap. And I say that about team because I've literally heard from the mouths of many growth equity investors we don't know. Like, we don't know what it takes to move from stick build to like a manufacturing line. We want to see that you've hired the people who have been there. We just want to see that you've hired the expert, that you found them yourself. And so actually, I think what's missing a little bit from that is what does your org chart look like with the use of proceeds of the B? Um, I guess there's the other way I'd mention that is like, do you have the sophistication internally to do the financial engineering required to make sure that things don't that to make sure that you have a plan and contingency for when things go wrong? So I often see this question of like, okay, show me what it looks like when CapEx blows out by 2x and you have an extra timeline for delivery and you can't make customer payment. Like, show me what that looks like on paper in the Series B stage. And it's like, great, here are the four levers. Like, what you should be able to respond with are here are the four levers for how I'm going to push my net 30 out to net 90 with all my suppliers. And here's how I'm going to, here's the customer I would ask first to, make an upfront milestone payment on that contract. Here's how I'm going to use a catalytic DAF-backed loan guarantee for this portion of the insurance that I want on that delivery. Like that type of control over your capital stack and the financial engineering required if things go wrong. It's not necessarily a metric, but it is like the DDQ answers that I think are important at those growth stages.
I think this is a perfect transition to our last session, which is all about capital efficiency, because we've now touched this in so many different ways. We've talked about where sort of equity plays a role, when people should start thinking about project finance or equipment finance. And so I want to go a little deeper into this as we get into our last half hour. And Super, I think you brought this up actually first. So we'll start with you. Um, Obviously, like capital efficiency means different things in different business models, right? Like a capital efficient SaaS business looks very different than a capital efficient project developer. And so how do you communicate capital efficiency to prospective investors? Like how do you tell that story and what are the metrics that really matter there?
Yeah, good question, Dimitri. And I don't think a lot of investors really appreciate the importance of capital efficiency. So I have not had a lot of times where I've had to actually explain the concept of cost of capital to a lot of investors. So maybe I've gotten away with it. But there have been
That
a
makes
couple
me
of cases.
so upset.
This is one of those things where it comes to bite you if you're an entrepreneur or a founder, but a lot of board members will typically not ask you about it until it blows up to the extent that nothing can be done about it. And it becomes a feature of board meetings. But we have a very thoughtful panel, but that is not the case generally out in the world. But I'll answer your question. When it comes to, I think, running a business and having a capital efficient business, it's very easy to say that, but the reason why we all at the end of the day resort to venture capital is because there's gaps to be plugged and there is a lot of work done to plug those gaps. And the only contingent of capital that is one thoughtful enough to understand these risks and also um, thoughtful enough to take them and ride the wave with a founder, an entrepreneur, is this community. And there's a reason why we are all here sitting. But if you go to a project financier, if you go to top five banks, you take Citi, Bank of America, Wells Fargo, JP Morgan, any bank that writes debt at limited or non-recourse. If you go to them, they'll hand you a list of 8 checkpoints of like, hey, does your project have these 8 things? If not, come back to me when you do, and if yes, then let's talk about it. The level of thoughtfulness around risk reduces the more risk averse you go. We are a very thoughtful bunch here, but we're doing a lot of deep conversations that you would typically not have. And so I think the big point then becomes, okay, how do I, one, make my business ready to meet those 8 checkpoints? And that's an internal conversation to be had. No investor or board member who comes onto an early stage will push you like, oh, you have to prepare your business to be project finance ready. Because there's very few firsthand experiences that actually will be thinking about it in that way. Not that they don't know, it's just that it's just not top of mind for people. Um, and so I think the way that I have personally navigated that question, Dimitri, is one, I've done a lot of work to find the most thoughtful people who are in the more risk-averse category set of like, hey, can we stop being emotional about project risk? Can we be, Noah mentioned, hey, like it's a risk matrix. Not everybody speaks and thinks like Noah. Like people are not thoughtful about risk. I feel like a lot of conversations could be very productive um, if you had a limited recourse financier who's actually thoughtful about risk and not emotional about it. And that's been the biggest thing is in some ways my background helps is where I am able to help people get over the fear of the unknown and fear of risk when it comes to technical projects. And then once that emotional component has been surpassed, then you can actually have a very productive conversation sitting across the table from somebody saying, hey, these are the 5 risks that I'm actually experiencing. Be honest and open about it. And then talk through, hey, these are the 5 mitigants that I think could work. What do you think? And the mitigants could be anything from insurance that Hannah mentioned to your own balance sheet cash to getting on some form of structuring on your parent company or the project level that gives any external capital comfort that, hey, you know what? If things were to go wrong, I will not lose all my money. And when decision making is done with fear as the driving factor as opposed to upside, because a lot of risk averse capital, they don't get to participate in your success. They're just afraid of losing their jobs when you don't work out. And so when fear is the driving factor and not upside, the conversation becomes okay, let's be thoughtful about it and let's get you out of that fear mindset and let's get you really dialed into what we're doing. And here's me being really honest and authentic about what I can and can't do today. And let me know how you think we can plug these risks because I think there's a great way we can work together. That's been the conversation for me.
So much there. I I really appreciate that perspective. Laurie, I'm curious to like almost ask you the same question. How do you guys think about capital efficiency within your portfolio? Because I think you're one of the few VCs, and this is maybe, I hope I don't offend anyone in the room, but you're one of the few VCs I've actually heard speak positively about companies taking on debt, being creative with capital efficiency. A lot of folks have, I think, not productive perspectives on how companies should capitalize. So how do you guys think about capital efficiency within your portfolio? And then for individual companies, like how do you guys work with them to sort of navigate this journey?
And I don't know if people are not productive investors. I think it's more like a lack of expertise. And when you invest in software,
Yep.
I mean, venture capital equity makes sense, but when you are in hardware, it makes no sense. And Supra talked a bit about it, but yeah, debt, equipment financing, leasing your equipment makes sense. Don't spend equity on buying equipment, especially if it's common equipment that can be resold. Just lease it. But beyond just the structure of capital, there is something as the company grow. I mean, when you are seed stage, Series A company, most of your costs are going to be related to labor. As you scale, this is going to shift from labor to CapEx, to equipment, to buying lands, stuff like that. And the mistake I see from many deep tech companies is that everybody wants to do everything in-house. I want to build my own manufacturing line. I want to build all of the system myself. Oh, I don't want to outsource anything because there is a secret sauce here. And if they know about it, if I outsource the manufacturing, they'll know and they are going to copy us. That's, I think, a big mistake because if you decide to do everything in-house, first, it's extremely hard to scale, to manufacture hardware. You need to have the right people and you need many of them. And it's also super expensive. If you need to build a manufacturing plant, you are going to waste dozens of millions of dollars, hundreds of millions of dollars, and you don't even know if you are building the right manufacturing line because scale up takes time. So what I'm advising the portfolio companies is let's look at contract manufacturing first. Let's look what you can outsource. Okay, maybe there is something super secret. Maybe you keep that in-house, but try to outsource everything else because you'll have to waste less money. From a cash flow perspective, it's much more interesting. And you are going to leverage people who've been doing manufacturing their whole life. You are going to learn from them. You are going to start generating revenue. And once you are on this good trajectory, at that point, maybe you'll build the manufacturing line. So that's what we are very focused on with the portfolio companies. It's capital efficiency in terms of scaling up the hardware and making sure you are not taking all of the capex with equity and you are trying to outsource all of this capital.
Yeah, I think a framework that we usually use with founders is that um, you should align your capital with the certainty of the outcome, right? And so I think there's even a comment here from Sarita about their experience raising equipment financing pre their Series A. And if you're buying off the shelf equipment that has a certain liquidation value or residual value. It's coming from it has a large market for resale. You can easily get equipment financing very early in your journey, right? And even in cases where it's not super off the shelf, there are cases we've seen with folks like Caneo Finance where they will do early stage equipment financing for companies. The same is true for like working capital. If you have a clear contract that has a clear path towards revenue and very little performance risk, you can finance it with debt, regardless of how early you are. And that's what we do all day at Enduring Planet. And so I think the question really becomes like, what are you financing with the money? And oftentimes, I think there's also been some comments here about, oh, well, I want to get project finance for my first offtake. Like, it's not going to happen because your first offtake, the performance risk on that is so high that infrastructure investors or credit investors are going to really struggle with it. But if you have data to show that you don't have performance risk, that's a different story. So I want to come back to I want to come to Noah real quick. So your ARL framework calls out like manufacturing and supply chain maturity as a prerequisite for scale, but those are often really hard to like quantify and show in metrics, right? So what does that like a capital efficient path through this manufacturing scale up process actually look like, and how do you evaluate it as an investor? And I think there maybe this is you can repeat some of the points you've made in the chat too about this because I've seen some of this come up, right?
So we're talking about capital efficiency within the context of manufacturing in particular.
Yeah.
Well, I think maybe a couple of points. Like one is a very general high level one, and I spoke about that schedule of risks and there sort of being this like critical path through that. And so I think spending money outside that critical path in general is just the definition of capital inefficiency. And so it's quite a hard one. I'm trying to think of some specifics. Within the manufacturing context, maybe, I mean, Supra, has anything firsthand come to you on that? I mean, maybe I just want to because rather than give you a very generic answer on the manufacturing side, I'd rather come to something firsthand, I think. Maybe Super might
Yeah.
have one as well.
Yeah, and I have two specific manufacturing experiences that I can speak of. One was in the green hydrogen world, where it's a combination of things made inside of a factory and things made by contractors outside of a factory. And there's a bit of both. That for industrial heat that's you see behind my head, this box that sits behind my head, it has bricks inside of it, and that was made inside of a factory. But the power electronics equipment that sits inside this shipping container like thing was bought off the shelf and dropped. And as you can see, there's not a lot of like stuff on the ground. This is mostly a light contracting work on the field. And what I learned from these two experiences is there is a controlling your destiny point here that is sort of becomes really gating. When you're selling unit economics to investors, and frankly, it's not just investors, your very survival of the company depends on it. Um, the understanding of costs, fully installed, fully landed costs that goes beyond bill of materials, that includes site shipping, labor, site prep, installation, um, can be hard to do when there are external parties involved who don't fully understand the design of your thing. Now, the complexity varies by industry. Uh, Green hydrogen equipment, for example, is somewhat complicated because you have, effectively water and like fizzy water, gas, and hydrogen and oxygen bubbles, and hydrogen corrodes stuff and can be is flammable, and so you gotta control for that stuff. In hot bricks in the industrial heat world, it's pretty boring in the sense that it's just no moving parts, bricks heating up to high temperatures, pass air over it. Um, but I've seen that a combination of uh, outsourcing the stuff that Laurie was mentioning that people can understand easily and can be done relatively easily works. But the stuff that has I was just reading the chat, got fizzy water and gas. It's funny. Um, the combination of you doing something new, you have to control your own destiny for it, because if you try to explain your design to a contract manufacturer, like that thing is going to get built at twice the cost of what you want to get built. For this thing behind my head, the steel casing for this, I think, was 3x of like what we thought it would be. And it's such a boring thing. Like, who would imagine that the steel casing for bricks would be that expensive? Because you don't think about that. But that was the reality of it. And we're like, well, that's not good, because that's going to break our unit economics, and we have to figure out how to get cheaper steel. Or I guess, like, is this how much steel costs? Like, I thought we knew that. Um, and so that's where controlling destiny comes into picture, and some in-house, putting some capex into having some in-house capabilities that allows you to do that part better than other people. And then eventually, once you get the reps in and people see this working, and you have designers and engineers who've come along with you on the ride, and they say, you know what, we get it. And this is a public thing. We have announced a partnership with a pretty large brickmaker called Harbison Walker International. We are making these bricks in-house, but we also have a partnership with an external, very capable brickmaker, and we're piloting a manufacturing line with them. And eventually, it's going to be a slower transition to them. But for now, we're investing the capex on the manufacturing side to make sure this comes out at cost, it works, and we can do it again, at least for the next 1 to 2 years, because we got to do that to survive. That's the perspective that I've learned from my 6 years in hardware operating.
Yeah, I mean, amazing first-hand experience. I mean, some others that came to mind as you were talking. And again, I mentioned that, I went and spoke to a load of folks who just finished their Series A, trying to get a bit more color. And so, I won't name names, but I'll just give you some firsthand. I mean, a lot of people talking about anchoring to existing infrastructure, so you can take some of the other headaches off your plate, so to speak, right? Whether that's power availability, water availability, steam, things like that you otherwise would have to build yourself. So a lot of the utility infrastructure being in place. Obviously, modularity, I think obviously people talk about it a lot, but being able to have repeatable modular units within a larger site that you can scale up is obviously a big one, and that's still part of manufacturing. Um, just getting the size right, I think. I remember I was in a meeting. This was a few years back, but it sort of blew my mind. This company had raised a lot of money, and they had sized the site relative to what basically was most attractive to the clients that they could get. So they basically said, okay, we'll make it big so that it's attractive for someone to come in, which is like chemical engineering 101, size it to the demand. And so off the bat, suddenly they're in hot water because now everything's off. Um, and so totally capital inefficient. And then finally, phase site deployments. And so, speaking to a team, and they basically had their engineers who did the design on site while it was getting built, so they could see firsthand what learnings were coming up, and they could integrate it into the next one, and they could see it firsthand. And so, that was hugely beneficial for them.
This has been such an amazing conversation. I have a few reflections, if you'll let me interject, Dimitri, on
Yeah. Well, I was going to come to you talk in a second about something related. So why don't you start with yours and then I'll follow up with my question.
perfect. Um, if I could summarize some of the legs of the stool that I heard out of this conversation, every founder is making trade-offs between pretty much four legs of the stool: speed, cost, diversification, and the vision. And the speed component is if you have elements of the technology that you are still working on or need to validate or want to iterate for, there is a speed component to doing that in-house. One of the companies that comes to mind is Arbor Energy, which really does, they do basically like jet engines to use biomass and natural gas in a carbon-free way to power data centers. Yeah, it's a data center company, lots of demand, blah, blah, blah. But the speed component is like they go to Home Depot, they buy stuff off the shelf, and they use their SpaceX engineering team to like rapidly iterate in-house. And there's viable speed that comes from that level of iteration and doing it yourself. You're making the trade-off with costs. And like, if I were founding a company, I would want Laurie on my board asking me these questions about how could I be using contract manufacturing? Where could I be reducing costs in this scale-up process? Like, how do I think about better forms of the capital stack to get me there? And that cost component is like, if you don't perseverate on it, you will miss opportunities where actually 90% of that could be bought from Home Depot. And then eventually you go straight to the contract manufacturer. To Supra's point, it's like, you want that partnership that you're going to announce to the world who's just going to print bricks with you. Um, and there's real margin to be saved with contract manufacturing that could be way more expensive if you go build a manufacturing facility yourself. But the diversification point also came up, which is you might want a little bit of production supply of those own bricks you have in order to diversify across what is really volatile in today's supply chains. Like, we don't even need to reference the Strait of Hormuz right now for everyone to understand that point. I had a client of mine who procures hydrogen, green hydrogen, for a use case in which they're the OEM and supplier of that use case. And we've had like weeks and weeks and weeks of hydrogen shortage because there was a fatal incident on a highway or with a hydrogen truck in California, and it like paused all supply despite the fact that we had diversified suppliers of that green hydrogen. And so having a little bit of manufacturing capacity in-house, sometimes that's a diversification strategy. This vision point is what I really want to hammer home, and it has been embedded in this conversation, but maybe not articulated explicitly. You, founders, have to decide who you want to be when you grow up. And then you have to balance the stool of speed, cost, and diversification against that vision. And what do I mean by that? If you are going to be the best in the world at producing bricks, like let's use ETS as an example, if that's your secret sauce, maybe it makes sense to spend a little bit more cost upfront in order to have that speed of production in-house. And maybe then you have an intense debate with Laurie about contract manufacturing, and ultimately you agree with your board and your investors that this is a worthy investment in the upfront manufacturing because that is what you're going to be best in the world at. You're going to print bricks, and that drives your business model. And I think, like in the case of Arbor, for example, they're able to earn billion-dollar offtake agreements because of the data center market right now and because of the creditworthiness of those buyers of energy they're willing, they can take that type of risk. It's like justified to do that. In other cases, your future, your destiny and vision might be that you need to be the builder, developer, owner, and operator of these projects. You are never going to be the one who just prints as an OEM and you need manufacturing. And therefore, your strategy might be more aligned to we need to partner with contract manufacturing and developers and insurance providers to do that project financing really well. Those are very different business models and outcomes. And if you're going to go different pathways, you might need to be more, being capital efficient means different things depending on what your end state of your business is. And that should not just be an investor driven conversation. Like just because a VC tells you it's more capital light to be a licensor, that doesn't mean that that's right for your market or your technology. And so you need partners, honestly, in my opinion, like Laurie, you need talent like Noah and Supra, like with you on the journey, who are helping you iterate on that in real time and come to like a informed point of view about what the vision is.
Such a good synopsis and insights. Thanks, Hannah. Okay, I actually going to skip your last question, and I'm going to go to our rapid fire quick thing, because we're about to be out of time, and I just want to ask everybody to give me like a 30 second to 60-second answer to the following question. What's one metric that you wish investors asked about more from your, like, if you're an investor from your portfolio companies, if you're, super from your company, like what's one metric that you wish they asked about more, but they don't, that like nobody brings up? I don't know, maybe Supra, we could start with you. Literally 30 seconds. What's a metric that you wish they cared about that they don't seem to care about?
I think the team, honestly, like
Mm,
somehow in a surprising way, I've had very few investors ask about the team and why we are the best team to execute. We talk about products, we talk about contracts and offtake and everything else, but especially in the earlier stage, you're investing in the people. And um, I thought that earlier stage investors spent a lot of more time with the human beings around the team, but somehow my experience has been different. And I don't know if it is just me, but there seems to be a mad focus on commercial contracts and revenue and dollars over the human beings behind the thing. And then I guess in hardware, the human beings matter a lot because at the end of the day, like we're talking EPCs, you're talking manufacturing, you're talking trust, and you're talking the credibility to sit across from another human being to drive credibility on product and engineering. And I think that investors, I just haven't seen them spend time on that for some reason. But maybe it's just an artifact of mine, but that's my 30 seconds.
okay. Let's go, Laurie.
So what I would like to see other investors asking
Yeah,
more,
like what, yeah, just ask of your portfolio, because like what's a metric that they should care about that they don't generally care about?
it's back to the same thing. It's unit economics, but unit
Mm,
economics also related to scale up with yield, with cost optimization of lines, stuff like that. And it's scale up and manufacturing. And back to Supra, team is key, but it's the composition of the team and the skills. And as the company weighs more capital, the team needs to evolve and needs to bring skills related to manufacturing and scale up, and hopefully from established industries within those companies.
okay. Noah?
Your original question is what's one thing that investors cared, you wish they cared less about?
No, it's what's one metric that they should care about more but never ask about?
Should care. It's less a metric, but I wish it was more front of mind how you get off the VC treadmill sooner.
Ah,
Um,
yeah.
um, that would probably be, and we're privileged because we sit at the very start of the funding
Yep.
timeline, right? So like less dilution for us, great. But I do think that the sooner you get off, the better, if
Hannah,
possible.
close us out. Drop a bombshell.
I think it should be uh I think it should be what is success in the eyes of the executive team? What would they be like what does the end state look like for their team? It's not the question, what's the exit for your company? Because I think that's
Yeah.
too immature to ask, but it is an emotional question of what is success for you, and then making sure that there's alignment in that conversation. Of course, lenders never ask that. Lenders are all about downside protection. But I think venture capitalists at the Series A and B stage should be asking, hey, like I can underwrite to a 500 million M&A outcome. Is that success to you? What does it mean?
Love it. All right. In the nick of time, thank you so much, everyone, for joining. This was so rich, so good. For everyone attending and for folks who couldn't, we will collate all the insights into a summary. We will publish the recording and those insights as soon as Hannah and I can find some time to do so. Thank you, everyone. Hope you have a great rest of your week and enjoy building in climate. Cheers.